Good morning, everyone. David Blaine here. I wanted to bring you some update on what's going on in the markets. Unless you've been on vacation, I don't know, on Mars or somewhere, you may have missed the past couple days ever since the announcement of the tariffs by the Trump administration. It's really rocked kind of the whole world. So even if you're on vacation in Tahiti or something, you probably heard about it. But anyway, we wanted to talk about what's happening, what you should do, if anything, about the current economic landscape. So here we go. Hope you find this interesting. As always, reach out with questions if you have it, but I'm going to get through a few of these slides here. First of all, what exactly happened? Well, the problem, and I've identified 5 things here. You can agree or disagree with these, but these are these are facts that have been presented. And I'm just kind of recapping here. So number one, unfair trade practices, meaning tariffs on goods going into a country, but different ones for the U.S. Once again, we're not here to debate, is it the right percentage, the wrong percentage, or whatever. The reality is different countries have different tariff regimes, and those are perceived by some people as unfair. Okay, that's the facts. Number two, spending deficit in the U.S. is over $2 trillion a year. That's true. That's a fact. Number three, there's $37 trillion of national debt. That is a fact. Number four, the loss of manufacturing jobs in the United States has been significant. Depending on where you look, certainly if you look in the past several decades, but it continues to trend down as we go forward. It's a fact. The manufacturing jobs have left the U.S. And number five, which we knew was true, but was really highlighted significantly in COVID, was dependency on other countries for critical items, pharmaceuticals, rare earth materials, medical PPE, all sorts of different types of things. Certainly our military, even our military, our fighter jets and electronics and things like that. It is a fact. We are dependent on other countries for critical items. Now, how you solve these problems is where a lot of the debate of different ideas come and everything. But this is the problem that the current administration is trying to solve. The proposed solution was tariffs. Once again, we're not here to debate whether this is the right or wrong reason. We're recapping what is going on and why we're in the situation we are today. The tariffs were introduced to correct unfair trade dynamics. Whether that will work or not, we don't know, but that is what was proposed. As you know, it may lead to increased costs and market disruptions. That's the other side of the problem. It may fix some of the problems. The point is nobody knows, and you can watch the internet for 24 hours a day, left wing, right wing, down the middle, nobody knows. Finance people, economic people, government people, nobody knows the answer. There are historical precedents for tariffs working. There are historical precedents for not working. Today is a different circumstance than every one of those, so nobody knows. Anybody that says they do or they have the right answer, they don't. These are theories. Some of them may work, some of them may not. The key, and we're going to start moving into what's happening and what to do now, is what it has done, though, we know as a fact, it has introduced uncertainty, okay? Whether it's going to work or not work, what has happened is there is a massive amount of uncertainty about the side effects of these new policies. And that's what we're going to focus on here, is that uncertainty. And that economic uncertainty always causes market problems. The markets love certainty, whether it's this issue, tariffs, or we're going to talk about some other historical precedents. When things the rules are known, markets like that. When they're not known, businesses hold back investment. They don't know what to do. Just like yourself, it's uncertain. Well, businesses are the same way. They don't know exactly what to do. And so we have uncertainty. And that has resulted here in a 1-week return. I've sorted it. my eternal optimism. So I've sorted it by positive return first, sort of the 15 main asset classes. You can see there at the top, long-term treasury bonds up 3.3% for the week. Down at the bottom, the S&P 500 minus 9%. You also see right above that the EAFE, that's Europe, Asia, Far East. Unfortunately, the trend that had started earlier in the year, which the European markets had been doing very well, has not held the past 1 week. If you go over 1, 2, 3 columns to year to date, you can see the European stocks are only down 0.78, less than 1%, where the US S&P 500 is down almost 14%. So a lot of data on this chart. But what I wanted to illustrate was, number one, the uncertainty that's just taken place the last week. And if you'll go out with me a little bit further, the 10-year returns on the far right-hand side. And I'm going to come back to this in a minute. But you can see there, the S&P 500 10-year return, 11.28%. The next highest thing, it's not sorted in that order, but you can see there's a 9, it's been gold. But all the other equity markets and the bond markets, low single-digit 10-year returns. So the past 10 years, except for the S&P 500, the U.S. large companies, and gold, and by the way, most of that gold return has happened in the past 12 months. You can see there in the 12-month return column, gold up 32%. Although it hasn't been spared this past week, it's actually gone down. But that 10-year return, those are very unusual numbers. And so whether it's the tariff or some other issue, the markets were due for a correction, certainly in the U.S. large companies. You just don't have a decade return like that with such a divergence of the U.S. market. And so we're going to talk about a little bit. I went back to 1950 and looked at all the different corrections of 20% or more. You can see there, 57, the Eisenhower recession, the Great Society programs of Lyndon Johnson, introducing massive amounts of government spending, actually produced a recession, a lot of uncertainty, a decline. Then, I'm sorry, I skipped the Kennedy, under the Kennedy years, the Bay of Pigs, the Cuba crisis, minus 28%. Then, of course, we had the Vietnam War and inflation, minus 36% between 68 and 1970. We had the oil embargo. I remember this, maybe some of you do too. 1974, and then in the early 80s. This is actually when I started first investing, believe it or not, in the early 80s. Started buying CDs with money I earned cutting grass and delivering newspapers and things like that. I remember Black Monday, 1987, was shortly after I first started investing in stocks. Unbelievably bad timing. Lost 34% between August and December 1987. And of course, in there we had Black Monday. The Gulf War recession of the 90s. I was busy in the military overseas at that time doing other stuff, but markets went down. The dot-com bust was massive. Y2K, nobody knew. Was the whole world going to collapse with the computers not reading the year 2000? So we saw this 49% decline. We also, in there, of course, was 9/11, the terrorist attacks. That decline of the dot-com bust probably would not have been as much if it weren't for those terrorist attacks. It was kind of a double-edged decline there. Then we had the granddaddy of all, and sort of most of our lifetimes, was the global financial crisis, minus 56%. And then a couple of years ago, we had COVID-19, minus 34%. And most recently, in 2022, the inflation interest rate hikes triggered a 25% decline in the market. How soon we forget. That was a mere 3 years ago. We had a 25% decline in the market. So my point in this is what's happening today. Yes, it was triggered by tariffs, but this is not unprecedented. It's happened before, always a different reason. As I shown this time it's the same, or is it different? It's different and the same. It's always different reasons, but the same sort of result. This chart, what I wanted to show was on the left-hand side, you can see 5% decline. So the number at the bottom is the percentage the market goes down every year, or in a given year. So you can see it declines at least 5% every year. So on the left-hand side of the chart, it goes 0, 1, 2, 3, 4, 5, 6. That's the average number of years between these type of declines. So every year you're going to have at least a 5% decline. You're going to have a 10+% decline at least every 2.5 years. As we go out to 15%, you're going to see that every 5 years at least. And then you're going to see a 20% decline every 6 or so years at least. And then you can see also the average duration. So the height of that decline shows the duration as well as the frequency. And it has a nice, as you would expect, the bigger the decline, the longer it takes to get back even. So my point in showing this once again is this happened before. It's always a different trigger, but it has happened before. And every time, because I've lived through a number of these, I've been investing for a long time. It's always different this time, but yet it's always the same. And so this will be the same. It's a different cause, it's a different fact set, but unless you believe the entire world is going to collapse and no one is going to ever want to buy a new car ever again, or a washing machine, or food, or anything like that, the world economy is not going to collapse. Yes, it may be changed. Yes, there may be different winners, different losers, different rules to the game, but it is not going to just vanish overnight. There will be companies, which is what the stock market is made up of, that figure out how to make money in tariffs, no tariffs, US-centric, Europe-centric, China-centric. There will always be a way to figure it out. It's just that uncertainty. Remember, people are uncertain right now. Okay, so the other thing I wanted to mention, if we go back to the other slide, where we saw the 10-year return on the S&P 500 at over 11%, I'll put this together. This is a 10-year moving average of the S&P annual returns. And what does that mean? It takes the average 10-year return, and I went back, to the 1920s. What is the average return been if you look at every 10-year moving average? And you can see that the annual moving average returns coming out of the Great Depression, my gosh, recovering from that low base was very high. So the annual return over here on the side is the percentage return. So this dashed line here in the middle is 10%. Approximately the long-term average from 1926 to 23. You can see it was popped up there 20% a year, and it gradually declined into the 80s, the average return, and then it's been going back up. And I don't want you to focus on the numbers. I want you to focus on the way that this graph goes. It's the average return. Nobody knows what the average return is. But what you can see here has been somewhere around 10. And so recently we've been way above the average return. And so if you didn't know anything, you would expect that the average return of the market would start to come down. It's not just going to come down for no reason. There's always a precipitating event. And I feel like that's what happened. It was COVID, you could see, knocked that return down a little bit. And then it took right off again, but there's always a precipitating event. But this is just a natural part of investing. Why should you earn 10, 11, 12% a year on your money? Like what entitles you to just do that? You don't have to do anything. We do it for you. We buy things in the market. We click a mouse. Why should you earn that much money? And I tell you, a big part of that is dealing with the anxiety that you're dealing with right now, the uncertainty. You are getting paid an average return of 10%. And I don't show it on here, but the average return of the risk-free rate, treasury bills or treasury bonds, you're talking about 2 to 4%. Why should you be able to make 10? It's because you're willing to put up with uncertainty. You're willing to put up with the pain that you're experiencing right now. That's the simplest way that I can explain it. Stocks have an uncertain return, and every once in a while you have to get really uncomfortable to be entitled, so to speak, to make that return. So what should you do? Number one, if you work with BlueSky, this is already built into your plan. We already know this is going to happen. I don't have a crystal ball. I don't know when it's going to happen. I don't know how much magnitude. I don't know when it's going to recover. I don't know those things, but we build them into your plan. We do know that periodically markets decline. Inflation goes up and down. Interest rates goes up and down. Stock markets go up and down. Gold goes up. So we build this into the plan. It's already incorporated. You don't need to do anything. We already knew this was going to happen. So you don't need to do anything in reaction to market changes. If your life circumstances change, that's when you change your strategy. Now, maybe you got a little greedy the past few years and your circumstances changed, and maybe you should have gotten a little bit more conservative, but you got a little greedy and you didn't. Well, that's a discussion whether to do it now or not. But that is when you change the strategy, not in reaction to what's going on in the world. It's just nobody has proven successfully over long periods of time to be able to move nimbly in and out of different asset classes. There are hedge funds, there are money managers, all these people that claim to do it. And certainly there are going to be people that have claimed and actually legitimately predicted this tariff decline. I was reading an article the other day about somebody that said, "Oh yeah, I sold all my stocks of this tariff, and I hit it right." You're absolutely right. If you think about the number of people that participate in investing, from individuals all the way up to professionals, just statistically speaking, you would expect that some people get these predictions right. Like, you know that's going to happen. It's just the same people are not able to predict the sequential events. And so over a long period of time, it's just not a great strategy to try to move in and out of markets. Avoid reacting emotionally. That's exactly what's happening right now. A lot of emotional reactions. And I'm going to wrap up here with one of my favorite slides, not just in investing, but in life itself. There are so many people that are worried about what Congress is doing and what the global economy is doing and all these other things. You can't control that stuff, and they worry themselves sick over this stuff. Does it matter? Sure. It matters what Congress does. It matters what our president does. It matters what China does. But you can't control it. What you can control is your spending. You can focus on your spending. You can focus on your saving. You can focus on being diversified. You can focus on your goals, becoming clear about what you want so that you can create a strategy to achieve it. You can focus on your family. You can focus on being healthy, eating right. There's a lot of things that matter that you can control, and that's what I want you to focus on. You can't do anything about President Trump and these tariffs. You can whine and you complain, you can worry about it. You can't control it. It does matter, but you can't control it. So try to focus on something that you can control. And like I said, if you have a strategy set up with BlueSky, we're on it. We're tax loss harvesting. We're buying low. We're selling high. We're doing all those things algorithmically that we know what to do based on the strategy that hopefully you've put in place. So that's what I wanted to cover with you today. I hope that was useful. If you have any questions, please reach out. I know it's stressful. I'd rather be doing something else than watching the markets decline myself. So don't feel like I'm completely immune to it. But what I've done is I've been able to do what I just said, focus on what matters and what I can control, try to set the emotions aside, and life is a lot easier that way. So anyway, if you got any questions, please let me know. But hopefully we'll get this resolved as we go through the summer.